Episode 19. There are 19 vertebral bodies in your cervical and thoracic spine. My wife's birthday is January the 19th. In my opinion, the two best hockey players to wear the number 19, Steve Yzerman and Joe Sakic. And despite the Hockey News' latest ranking, I give the nod to Sakic. He's no ordinary Joe. And in 2019, the S&P 500 returned a whopping 31%, which means that you could have sat on your ass at home, invested in a total US market ETF, and made 31%. Beyond MD, episode 19, here we go. Welcome back, everyone, to the Beyond MD podcast. Feels like it's been a while. It's been 4 weeks since the last episode, so I'm really happy to be here. And I just want to thank everyone who's taken the time to join me. I am so grateful. Really excited for today's episode, which is going to cover another way to invest into real estate. And I know this resonates with a lot of us. So just for reference, my previous episodes, I covered mortgage investment corporations, better known as MICs, with Arjun Saraf in episode number 12. Dr. Kevin Milo joined me in episode 16 to discuss direct ownership of real estate. And today we're diving into real estate investment trusts, better known as REITs. And the tax efficiency of our REIT investments is essentially dictated by two factors. The first one is, which account are we using to invest into the REITs? And the second factor is the nature of the distribution from that REIT. And notice that I use the word distribution and not dividend because there is a difference when it comes to tax. So just to illustrate, I'm going to use an example, and that is SmartCentres REIT. And I'm not telling anybody to go ahead and invest in this company. I don't hold it myself, and I'm not telling anybody to avoid the company. But it just makes for a nice, easy to understand example. And the numbers I'm about to throw out, they apply to people who are investing into REITs through non-registered taxable accounts. So if I go to smartcentres.com, I quickly discover that the distribution has three main components. So the first component is other income, and that essentially makes up 63.5% of the distribution. And this component is going to be taxed at your top marginal rate. I can see that less than 0.5% of the distribution is made up of capital gains. That's very small, but that's going to be taxed at essentially half of your marginal rate. And then 36% of the distribution is made up of return of capital. And that's essentially SmartCentres giving you some money back, and that's going to drive down your adjusted cost base. Now that can make your accounting a little bit tricky, but it's a tax efficient way of receiving a distribution in a non-registered taxable account. Now, if you're investing into a REIT through a tax-sheltered account like an RRSP, TFSA, or RESP, which is a great way to go about it, then you can forget about everything I just told you because your gains and your distributions are going to be tax-sheltered. And that brings me to today's episode. And I thought this would be an interesting topic because I've talked to several people out there who are wanting to invest directly into real estate. And there's nothing wrong with doing that, but recognizing that it involves a bit more time and more sweat. And I know people who are trying to invest in university towns, and we all know that that can come with certain challenges. So then it came to my attention that there is a private REIT in Canada called Alignvest Student Housing REIT, also known as ASH REIT. And essentially what they're doing is consolidating purpose-built student accommodations across university markets in Canada. And the interesting thing about its distribution is that it is 100% return of capital. So it can be a tax-efficient way to get a distribution from a REIT inside your professional corporation. And the other interesting thing is that it's not going to affect your passive income limit with your investment. So you don't have to worry about losing access to that small business deduction because return of capital is not going to count towards your passive investment income. Now, as always, let's acknowledge any conflicts of interest. So my guest for today, Sanjil Shah, is the managing partner for Alignvest Student Housing REIT. But believe me when I say this, neither of us is telling anybody to go and invest in this REIT. I don't own any shares myself at this time. We are simply interested in talking about it from a macro perspective. It's very interesting what's happening in student housing in Canada. It's also a tax-efficient way to invest into a REIT through a corporation, given that the distribution is 100% return of capital. And then for anybody who wants to get access to real estate but doesn't want to put in the time and sweat and energy that it takes to manage your own property, then this is simply an interesting play. So just a bit on our guest, Sanjil Shah is a chartered accountant and he's the managing partner of Alignvest Student Housing. Previously, he was the CFO and COO of Storage Now Holdings, which was a real estate business that acquired, developed, and operated 11 self-storage stores in Ontario, Saskatchewan, and Alberta. And he subsequently sold the company for $110 million to InStorage REIT. Prior to this, he worked at KPMG, where he specialized in providing audit and advisory services to publicly listed technology firms in the US and Canada. He's also been an instructor at the York University Schulich School of Business, at the University of Toronto, and with the Chartered Accountants of Ontario School of Accountancy. And with that, here's my interview with Sanjil Shah. All right, Sanjil, welcome to the podcast. Where does the podcast find you today?
I'm actually in Winnipeg. It's it's a beautiful day in Winnipeg. It's actually 27, 28 degrees, so warmer than Toronto.
Oh, wow. That sounds amazing.
I was able to go for a run along the riverbank yesterday, and right after we finish our call, I'm heading out to go tour a property that we're looking to acquire.
Oh, very interesting. So looking to expand into Winnipeg, it sounds like. So Sanjil, I'm really excited for the episode today. And I want to just start off by maybe asking you a bit about yourself. And so tell us about your background and kind of your experience in real estate.
For sure. So I'm a chartered accountant by background and training, spent 8 years at KPMG, the large accounting firm. And then I had an opportunity to get into real estate. It was kind of a happenstance opportunity where I came across self-storage as an asset class. And this was back in 2004 when self-storage was new to Canada, but highly established in other parts of the world, the US and the UK. And the idea was quite simple. Can we just copy what's being done around the world and bring it to Canada and perhaps do it in a better way, learn from other people's mistakes, and really create something that is interesting, create value for our investors, and grow. And over a 3.5 to 4 year period, we grew from a PowerPoint presentation and idea to quickly become the second largest self-storage company in Canada. We did 3 developments in the Greater Toronto area and then started buying properties out in Western Canada. In 2007, had an opportunity to sell. Typically what happens if you stumble upon a good idea and are creating lots of value, copycats will enter. And that's what happened with us, right? So there was a new upstart entrant in the space who was aggressively competing with us. They had a lower cost of capital, so they could overpay for assets relative to what we were trying to do. And the gravy train or opportunity was, kind of diminishing. So it was in our interest to either take them out or let them take us out. And they were willing to pay a very healthy premium on our valuation. Yeah. And then fast forward to about 5 years ago, I came across the idea of doing student housing. And, in many ways, student housing and self-storage are remarkably similar. I like to jokingly say in self-storage, we were storing people's stuff. In student housing, we're storing people's kids. But parallels are striking. And what makes student housing really, really similar to self-storage is that it's an operationally intensive real estate sector. It's not a passive investment by any stretch of the imagination. And that's where a lot of people who think about real estate, they get hung up. They think real estate is pretty easy. You just buy the property, rents itself, operates itself. Student housing is anything but passive.
Yeah. And that's interesting. So we're going to dive more into the active versus passive nature of real estate. But so self-storage, that led you to student housing, and now you're at Alignvest Student Housing. So maybe just talk to us about Alignvest, talk about the target markets, the market share, your team, the philosophy. Would like to hear about this.
Yeah, so Alignvest itself is a private investment firm launched over 10 years ago by a group of successful entrepreneurs who were looking to invest their capital in differentiated and unique ways. And each of us, brings unique expertise and backgrounds and experiences to Alignvest. In my case, obviously, having done self-storage, I brought the real estate angle. And so when the student housing opportunity came around, I put my hand up and said, I really want to dive into this within Alignvest. And I took the lead and launched it. Now, within Alignvest Student Housing, within all of our investments at Alignvest, the idea is quite simple. We are typically the first investor, one of the largest investors, and if the opportunity presents itself, we'll invite like-minded investors to come along and invest with us. And in the case of Alignvest Student Housing, that's exactly what happened. The partners at Alignvest put in the first $20 million of capital to kind of demonstrate proof of concept. And then as we started to grow, we started to take in capital from outside investors. And, today we have over $220 million of invested capital from our investor base, including from the partners of Alignvest. And it's grown at a very steady pace over the last 3.5 years. In terms of how big we are, we own 11 properties with 4,700 beds, valued at $670 million. And located in 5 university markets across Canada.
Very interesting. So, from the sounds of it, with respect to market share, because when we look at REITs, Sanjil, we hear about a lot of other sectors in Canada, the healthcare sector, retail, commercial. Student housing is something we don't talk about as much, but it sounds like you guys probably have the biggest market share in Canada. Is that correct?
Yeah, for a discrete strategy that's focused only on student housing, we are the largest owner operator of student housing at Canadian universities.
And then can you just give us a quick summary kind of the target markets? I know you guys are pretty involved in Waterloo and Ottawa. It sounds like you're expanding into Winnipeg, and it seems like these are accommodations that are so purpose-built student accommodations near campus, but maybe slightly off campus. Can you just summarize the market?
Yeah, absolutely. So there's a lot to unpack there, right? So our strategy is to be across Canada.
Yep.
However, we have to be realistic. 40% of university students in Canada study in Ontario, so that's where the kind of the epicenter of student housing resides. From a personal or selfish point of view, I'm based in Toronto when I'm not traveling, so I wanted to quickly get to our properties in our first couple of years. If there's a problem or an issue, I want to be able to hop in the car and get to Waterloo in an hour and a half, or fly to Ottawa in 45 minutes. So that's why we focused on kind of those markets up front. And then, from a business perspective, there are huge scale efficiencies, operational efficiencies to be had when you own multiple properties in a market. So Waterloo is a fantastic market for us for several reasons. First of all, there are two universities in Waterloo, between the University of Waterloo and Wilfrid Laurier University, almost 60,000 students between those two schools. What makes Waterloo particularly compelling is it's just far enough from Toronto that kids who grew up in Toronto can't commute back and forth. They have to live in Waterloo. So everybody who goes to school in Waterloo needs to live there. And so that's kind of how we look at it. But, Southwestern Ontario as a whole, there are 6 fantastic schools, including the 2 in Waterloo. You have McMaster in Hamilton, Brock in St. Catharines, Western in London, and Guelph. So from an operational efficiencies point of view, that makes a lot of sense. Same thing if you move over to Eastern Ontario, in Ottawa, you've got the 2 universities, Ottawa and Carleton. You go south a little bit, you've got Queens and Kingston. You cross the border, and in Montreal, there are 5 fantastic schools. So again, from an operational efficiencies point of view, if we're setting up regional clusters, it makes a lot of sense. Now that we're established in Ontario and have a good operating base, we're starting to branch out and look across the country. Last summer, we did our first acquisition outside of Ontario. We did a small acquisition in Edmonton. And, as you mentioned, and I've mentioned, I'm in Winnipeg today, and we are looking at opportunities coast to coast. Next week, I'm out in Halifax to go look at a couple of properties out there. A couple of weeks ago, I was in Calgary. So, it's really just, where are the opportunities? And it's really focused on the strength of the university. We're looking for large, established, growing universities. We like to say we have this internally coined term, a tier 1 university, which we define loosely as a university that has over 10,000 students, growing enrollment, ideally attracts a lot of international students, and does not attract too many commuter students.
Okay, that's a really good overview, and it sounds like a pretty good growth story for you guys. So maybe now let's maybe pivot a bit, maybe talk about real estate investment trusts, better known as REITs in general. So Sanjil, maybe you can just quickly summarize what is a REIT, and kind of what criteria does that REIT need to meet to be called such an entity?
Yeah, so there's the kind of the legal and tax-driven objectives of what a REIT is, right? It's a real estate income trust. From a regulatory perspective or CRA perspective, it's effectively the same as a mutual fund trust. The mutual funds that everybody's accustomed to and understands. And what makes a trust unique is that it is a self-contained entity, right? So it is in itself the entity. So there are different types of entities. You can have a corporation, a limited partnership, or a trust. And a trust is just another legal entity form. Specifically, why a REIT structure works in real estate is that the income generated by the properties is not taxed within the trust. It flows through to the ultimate investor. So, if in contrast, if you think about a corporation, a lot of professionals have corporations. Your tax is contained within the corporation, and then if you want to extract the income or flow it through to you at the personal level, there's kind of a second tax that has to be paid. Whereas in a REIT structure, there is no tax paid at the REIT level. All of the tax is paid in the individual end investor's hand. And what's really, really attractive about real estate in particular is that you can flow through the characteristics of the underlying income. So if you have rental income, it's just ordinary income and it's taxed at your marginal tax rate. So nothing special there. But if and when you have a sale of a property and you generate capital gains, you can also flow through the capital gains to the end investor. So it becomes much more tax advantage to be able to manage the tax outcomes in your personal hands versus having done at the entity level.
Okay, perfect. We're going to get into the taxes in a little bit more detail shortly. But in terms of investing in real estate, different ways to do so. Some people like to own it directly. Other people like to take a truly more passive approach through a REIT. So, Sanjil, what are the basic pros and cons when it comes to REIT investing as opposed to owning real estate directly?
Yeah, so look, the obvious con, which could also be a pro, is if you own property directly, you're hands on. It's your property, and you have to manage it. You have to fill it. In the world of student housing, particularly, I've said it's operationally intensive, and what that means is, you think about your tenant base. We're dealing with students. We're also dealing with their parents who are paying their rents, and then we're dealing with the universities that we serve. We got too many constituents to manage and deal with, right? So if you as an individual investor go buy a small property, let's say in Waterloo with 20 units, that means you've got 20 different students to deal with, 20 sets of parents, and potentially the two universities. So is that something you're set up to do? And maybe you are, right? But when you deal with a REIT, typically it comes with professional management that can oversee all of those burdens and hassles and opportunities. And then, then the other point to make is that if you own direct real estate, you're limited to what you own, right? So if you own that 20 unit building in Waterloo, that's your exposure. If there's a downturn in the Waterloo economy or for whatever reason, one of those two schools experiences trouble, you've got exposure, right? And when you invest in a REIT, typically it's a larger entity and it's got more properties and you're diversified across different schools, different sectors, different markets. So you get that kind of spread in risk, right? Any investor, whether it's real estate, equities, bonds, we'll talk about diversification and the power. And real estate is no different, right? Do you want market-specific risk, or do you want to actually maintain the underlying real estate attributes?
Yeah, fair enough. Now, would it be safe to say, though, like if you're directly owning real estate, a few of the pros that I can think of is, well, that investment, that's your baby. You have control over that. And then also certain tax efficiencies that come with write-offs. Those are maybe two benefits I could see to directly owning real estate. Does that sound reasonable to you too?
Well, so let's think about that. The taking care of the property, it's your baby for sure. The flip side to that is a REIT has scale, right? So, if you own a small building somewhere and you have one elevator, you're going to pay market rates to repair that elevator every time it breaks down. If you invest in a REIT that has maybe 50 elevators in its portfolio, you get some scale efficiencies, right? So you get to leverage the costs a little bit more efficiently, right? We've got 5 properties in the Waterloo market. I can bet you our snow removal costs are lower than the single asset owner. So that's kind of how you look at it. But for sure, if it's your baby, you're gonna pay attention to it. Now, in terms of tax, we talked about that briefly. The tax advantages of owning real estate directly versus owning through a REIT are debatable, right? Because we talked about the flow through attributes of owning real estate through a REIT. So unless you are looking to write off some of your personal expenses within your as part of your real estate, and perhaps your travel to and back from the property, maybe some other expenses that are related to the property in a loose way, you can write off if you own the property personally. But for the most part, tax is fairly integrated, whether it's through a REIT or owned or the real estate is owned personally.
I want to just talk about evaluating a REIT. So obviously REITs are traded on the stock market, but I think they're still regarded as a separate asset class. So sometimes when we see that they're traded, we start to look at things like the price to earnings ratios. We look at payout ratios. But then it's kind of come to my attention just through a bit more reading is perhaps we should be placing a bit more attention to a term called funds from operation. But maybe you can kind of tell us when we're gauging kind of which REIT to go for, how should we be evaluating them?
Yeah. So let's kind of step back for a second. There are 2 types of REITs. There are private or unlisted REITs, and then there are public REITs. So Alignvest Student Housing, just for full transparency, is a private REIT. We're not traded on a stock market, and that's intentional, and I'll explain that in a second. Versus some of the larger, well-known REITs, I mentioned Cap REIT earlier on. That's traded on the TSX, for example. And so when you look at a REIT, one of the attributes when you look at a REIT that's trading on the stock market or an exchange is what is the premium or discount relative to net asset value. So that's something that investors can take into consideration, right? So, and what I mean by that is if you look at any publicly traded REIT, it trades, buys and sells are based on market-driven sentiment, right? If you think it's a hot market, you're going to pay a higher price, and if you think the market's tanking, you're probably going to dump your units of the REIT at whatever price you can get. That may or may not be reflective of the net asset value of the underlying assets, because if you think about it, a building, the value of the building doesn't change day to day. The building is there, right? Nothing, what happened today doesn't impact what happened yesterday, right? So, in the first instance, it's worth differentiating between a public and a private REIT. The reason why we are a private REIT is we don't have to suffer the consequences of market-driven volatility. Our properties are valued based on net asset value. We have a third-party appraiser. We use Cushman & Wakefield. Every quarter, they give us a valuation on our properties, and that's what we buy and sell units for. So there's no market-driven sentiment or emotion involved in the pricing of our units. And in fact, it's probably worth digressing for a second. That was very powerful and played itself out in a very important way in the depths of the pandemic. If you look at how public REITs traded last March and April, almost all of them, the unit prices plummeted 30 to 40%, right? 20 to 40%, let's say. And that's because the market-driven sentiment saw that the pandemic's going to be here for a while. Office vacancies are up. Nobody's shopping in retail. Hotels are empty. And so the prices started plummeting, right? And then what happened is over the following 15 to 16 months, those valuations have come right back up, and in some cases are higher than they were pre-pandemic, right? So if you were in a publicly traded REIT and didn't time it well, you might have missed out on the opportunity if you started selling your REIT units kind of in the depths of the pandemic last April and May. But conversely, if you were astute and recognized that this is a short-term sentiment-driven outcome, you were loading up on public REIT units because you said, look, this is a once-in-a-lifetime opportunity to buy these high-quality names at 20, 30% below net asset value. And for those investors, they have been rewarded handsomely because now they've made incredible returns in the meantime. Now, when you contrast that to a private REIT structure, we didn't have that same volatility, right? Our appraiser said, no, nothing's changed. The students are still living in your buildings. We know that this is temporary. As soon as the universities open up again, your properties are full again. So we didn't have that huge dip and follow on recovery. Our unit price was fairly stable. So and what that the investment term that leads to is volatility, right? So if you're looking for smooth, stable returns, then you don't want volatility. You want to kind of have that straight line, consistent growth, and that's what you can get through a private REIT structure.
So yeah, I did notice that many publicly traded REITs got totally decimated in March 2020. But just for comparison, ballpark, like how much did your private REIT fall in that same time frame?
So initially we didn't fall at all. And I'll give you the actual numbers. So our unit price was $112 per unit when the pandemic started. And at the absolute low, which was September 2020, our unit price fell to 110.63. So, negligible. And since then it's recovered so that today our unit price is 114.50.
Okay. I didn't ask you about this earlier, but can you just kind of summarize your kind of annualized returns to date since, I think, 2018 and just briefly talk about your distribution?
Yeah, for sure. So our annualized returns have been just over 10%. That's the net amount that investors have received, which is comprised of two components. It's comprised of the distribution that unit holders get, which is just over 5%, about 5.2%. The distributions are paid out in the form of return of capital, which we can dive into in a second. But it's a highly tax efficient distribution, and then the rest of the return is comprised of the growth in the property values.
Perfect. So yeah, let's dive into that now. So I think many public REITs, I think it's probably on a REIT by REIT basis, but many of these distributions are essentially taxed at near the top marginal rate. So if you're investing through your corporation, maybe not the most tax efficient strategy, probably better to hold it in a tax sheltered account. But talk to us about Alignvest's distributions and how these are potentially more tax efficient.
Yeah, for sure. So we benefit from a couple of things. First of all, our buildings are all relatively newer, so they have high values relative to the underlying land. And what that means is that they generate depreciation or capital cost allowance for tax purposes. So remember earlier I said that the tax attributes flow through to the end investor, right? And what that means is that the buildings generate rental income, right? The kids pay rent. We have our operating expenses to run the buildings, and then there's the net operating income that's left. That net operating income is then shielded by the capital cost allowance that is generated by the buildings, right? Capital cost allowance is 5% of the value on a declining balance. And because our capital cost allowance is enough to shield 100% of the income, we're effectively delivering all of the distributions on a fully tax deferred basis to our investors. Our distribution right now is $6 per annum, $6 on 114.5 unit price is how I get to 5.2%. And why that's really powerful is, your audience will probably understand this more than most, is for people who are investing through corporations and in particular professional corps, where the passive income limits are tough to manage around. When you get a return of capital, it's not considered to be passive income. It's considered a return of capital, which is effectively you're getting your own capital delivered back to you in a very tax efficient way. And so, as a doctor, dentist, lawyer, accountant who's got a professional corp set up, it's a great way to generate cash flows in your corporation without having to incur the passive income limits and grind down your small business deduction. So we're getting lots of interest from professionals and corporations in general who are looking for interesting ways to shield income and not have to pay current tax. Now, what does happen, kind of the fast forward, what a return of capital does is it grinds down your average cost base. So this, without getting into the complexity or technicalities, if you invest at $114.5, which is our current unit price, and let's for simplicity say you bought one unit, and we return to you $6, that means your average cost base has gone down from 114.5 to 108.5. So next year, in 12 months, if you look to sell your unit, and let's assume it's been flat and our unit price has not grown, so you sell your unit at 114.5, then you have a $6 capital gain that you've incurred. But that $6 capital gain is way more tax efficient than $6 of ordinary income and having to pay tax at the marginal rate.
Yes. Okay, so let's just drive that point home. So the distributions from Alignvest are going to be monthly. If you're investing through the corporation, then those distributions, they're not going to be taxed like dividends. They're not going to be taxed like interest. So it's return of capital, driving down your adjusted cost base. So when you sell down the road, you're basically going to be generating a larger capital gain. And currently the capital gain inclusion rate is 50%. And whether that stays or not, we'll see. But that's kind of how it works, right?
That's right. So two very important things there, right? First of all, there's deferral and no impact on your passive income in the near term.
That's very important.
And the second thing is you're turning potentially ordinary income into capital gains. So you're saving half of your tax there. So it is a very powerful tool, and we think that anybody who's investing through a taxable account should be considering this.
Very good. So Sanjil, let's move on to some macro items. So now, talk about inflation is kind of at the forefront now. Like I was just looking at some stats. Like if we look at the consumer price index, I think kind of year over year, it's up like 5.1%. If you take out food and gas, it's maybe 4%, so more than average. So people talk about real assets. So real estate commodities being kind of a hedge against inflation. Can you kind of just explain this to us? Why or why not is this the case?
Yeah, so in, real estate or real assets as a whole, are seen as an effective hedge against inflation because of what we've talked about, right? There is real property that is driving the value, right? So that real property, the valuations will continue to rise in an inflationary environment, and because there's rental income being generated, in most cases you can keep growing the rental income to offset or hedge against inflation. I think what's interesting and noteworthy is within real estate, there are different sectors and asset classes that you should look at more closely to understand how does it really protect us against inflation, right? And I'll give you a couple of examples. We live in Canada where most jurisdictions have rent control, right, for apartments, and in Ontario and Manitoba, where I am right now, there are pretty strict rent control rules in place, right? So what happens in an inflationary environment is that families are typically not going to move out. They're going to stay in their below market rents for some period of time, right? And so the landlord of an apartment building, does he really provide a hedge against inflation, or is he really protected? Well, in the long run, he is, but that's only as the turnover occurs. And in an inflationary environment, there's less turnover. Now, when you think about some of your core sectors, such as commercial, office space, industrial, retail, typically landlords are signing 5 and 10-year leases there. So again, in an inflationary period, it takes some time to catch up to the inflation before landlords can reset the rents. What's interesting about what we do in student housing is that we have turnover. Our tenants, our students, they graduate. So every year we have about 50% turnover, and we can reset rates to market rates much more efficiently than some of the other sectors. I would argue that perhaps the only real estate sector that has better inflation protection is the hotel industry, where rooms are repriced daily. But in the current environment, it's really tough to invest in hotels.
That's a really interesting comment, because I recently read a post by somebody on a forum, and they said, you know what, we have great tenants. We've had them for 5 years. We haven't raised the price. And now the rent that we're charging is way under market value. And you think about what you could get, but what you're saying is students come and go. And every year you have the ability to kind of reset the rent just to kind of keep it in line with kind of what the fair market price would be, right?
That's right.
But, it just talking macro, I see some positive discussion, because I was recently reading a summary, I think it was by Cohen and Steers, but they were kind of just saying that the price of a real asset today is probably the cheapest that it's been compared to public equities in maybe 20 to 30 years. As for how true that is, I'm not sure, because I've seen real estate prices like everybody else. They've skyrocketed in the last year too. But okay, let's just say they are cheaper. But then you have the prospect of perhaps rising interest rates in 2022 that are going to make real estate effectively more expensive. So you've got some positive dialogue, but then you've got some maybe negative factors, coming down the road in the very near future. How do you look at all this? How do you think about it?
Yeah, so I think it's a point in time analysis, right? So we talked before about the how public REITs, the valuations came down last March and April, and then they've subsequently come back up. And so, in today's environment, could we really say that real estate is cheap? That's a tough argument to make, right? Because you look at where interest rates are and where the valuations are, especially across Canada, and real estate is valued based on a cap rate, which is like effectively your expected return. And given where interest rates are today, you would expect that valuations would be high. And so that's kind of how you have to look at it. But, relative to stocks and bonds, are valuations high? I would say they're differentiated. And what I mean by that is, if you look at stocks today, the global stock markets, equities have been, frothy for quite some time, right? And, every month you hear about how the TSX or NASDAQ is, at an all-time high. And there's a lot of volatility involved there, right? So a lot of investors would say, okay, well, those markets are too frothy, too rich for me, and I want to take some risk off the table. Historically, investors have always said, okay, I want to be 60% in stocks, 40% in bonds, right? And that's kind of how the model portfolios were set up. The problem is, if you think that the stocks are overvalued today, where do you put that capital, right? Do you want to put it into bonds where the returns are negligible, and the returns, the real returns after you adjust for inflation, are negative? So there's no kind of opportunity for the average investor to say, what do I do with my 60-40 portfolio going forward? And what the investors should think about is, well, how are the more sophisticated investors allocating their capital? And there's this whole sector in between, the alternatives, which includes real estate and real assets, where you can kind of get that sweet spot in between, right? If you look at some of our largest pension plans, like CPP, they've been in alternatives for a long time, and it's especially for that. When you're in the alternatives, you get uncorrelated returns, so it's not tied to the stock market, it's not tied to interest rates that are generated by bonds, and the uncorrelated returns gives you good diversification. And when you look at the 60-40 model, you don't have the volatility of stocks, and you don't have the low returns that are generated by bonds. So real estate kind of fits in that nice sweet spot in between. And when you look at what we're doing, we talked about some of our returns a few seconds ago. We're providing very low volatility. I went through our returns. It's been fairly stable since we, through the pandemic. So low volatility or negligible volatility, and attractive returns, right? Getting a 5.2% yield relative to less than 1% from bonds, and highly tax efficient. Is seen as quite attractive.
I hear what you're saying about alternatives. It does sound like there's certainly, depending on how you invest, the potential for lower volatility. I think for people just looking back at the last 7-8 years, it's just hard to argue the returns of the stock markets. But we also know that what happened in the past may not happen in the future. So we have to kind of keep that all in perspective. Sanjil, quickly now, just trends in student housing. This is a really interesting sector. What are you seeing for kind of overall demand for purpose-built student accommodations, and what kind of accommodations are people seeking these days?
Yeah, so very good question. We've just gone through our leasing cycle for the September 2021 school year. First of all, our occupancy is at all-time highs. We're at 97% occupancy today across our 4,700 beds, which proves out the concept that student housing is resilient and defensive. The kids all came back to school. In terms of what are we seeing, there's a flight to quality. And what I mean by that is, historically, kids, were okay living in like the converted single family homes with, 8 of their buddies and sharing a bathroom and, and having to take turns doing a haphazard job and cleaning the place. Now kids are coming to us and saying, well, can I get a room with a private bathroom, an ensuite bathroom? Do you provide cleaning services? How often is your common areas, the lobby, the gyms, the study rooms, how often are they cleaned? Who's managing? Will we have security on site to prevent outsiders from coming in? So there's a real flight to quality being demonstrated. And that's something that we think is here to stay for the foreseeable future, right? It's kids want to have that safe, secure accommodation. There's a focus on cleanliness and hygiene, safety and security, and certainly in our experience, the rooms that we're renting out first were the private occupancy with ensuite bathrooms.
That is interesting. So there's a flight to quality, and in terms of that supply of quality, like if I kind of look at the numbers here, for purpose-built student accommodation, like quality accommodations, as a percentage of the student body, it seems like, is it safe to say Canada is kind of far behind its peers? Like when we look at the United States, the UK, so maybe we're kind of lacking supply. So maybe we can talk about some tailwinds, so supply versus demand, and then maybe the influx of international students. Like how is Canada kind of looking to its global peers on that front?
Yeah, for sure. So look, this is part of the opportunity that we recognized when we entered this sector, right? It's economics 101. Demand is high and growing, and supply is low and almost non-existent, right? In Canada, only 3% of our students live in purpose-built student accommodation. You compare that to the United States and the UK, and it's 10 to 15%. Wow. So, we have 1/3 to 1/5 of the supply of beds relative to our peers. And so even if the number of beds was to overnight double, we would still be far behind the US and UK markets, right? And so why is development so constrained here? It's really been because there's no institutional capital coming into the sector in Canada, or there has not been in the past, right? And so it's really been a business that has been driven by the local developers, the local entrepreneurs. Think of somebody who went to school in Waterloo, recognized this opportunity, started building a few properties, grew larger and larger and larger, but stays confined to the Waterloo market, right? We don't really have anybody doing this on a national scale the way we see in the United States or the UK. And so that's changing, but it's going to take time as professional operators come into the sector, such as us. Developers see the opportunity and say, okay, well, I can build, because now if I build, there will be somebody to buy my property. On the demand side, Canada has always had higher enrollment and growing enrollment. Effectively, Canada is a land of immigrants, right? So, the first generation immigrants come to Canada. It's an expectation that their kids will go to university, right, and further their education. So, our domestic student enrollment is higher and growing than most other countries in the world, and then our international student enrollment has consistently grown and outpaces other jurisdictions around the world, right? Just the other day, I saw an article and posted it on LinkedIn that noted that Canada is the most searched term for international students deciding on where to go. And it makes a natural sense, right? If you think about Canada, we have a few things working in our favor. First of all, it's pretty easy to get a student visa to come to Canada, right? You compare that to the UK and the US, specifically the US over the last 5 or 6 years. The political climate has not been conducive to getting a student visa. In contrast, it's pretty easy to come to Canada, and if you're here as a student, you can stay as a permanent resident afterwards, right? So it's a warm, welcoming, tolerant society, things that international students like. And then there's the cost element, right? International students are paying multiples of what domestic students pay to study in Canada, but it's still a fraction of what you pay to study in the United States or the UK. So, for the affluent families from overseas who are looking where to send their kids, Canada is seen as the destination of choice.
Let's talk about a few potential headwinds, though. I'm sure as COVID started, it must have gone through everyone's mind. People are going remote for work. And did you ever have that fear that perhaps a lot of university education could maybe follow suit? I'm just curious on your thoughts. Is that realistic? And any other potential headwinds kind of facing the student housing sector?
Yeah, for sure. So, I'll be honest with you. Last March, when every Canadian university shut down operations and said we're going remote and sent the kids home, there was a part of me that thought this is the end of our business, right? It's, online learning is here to stay, and nobody's ever going to come back to campus. But what we recognized is that people and kids in particular need that social interaction, that stimulation, right? Mm-hmm. Kids choose to go to university for more than just the books, the academics. They want to have that social experience, make new friends, grow up and become adults, right? It's the first time they're leaving home, leaving mom and dad, becoming independent, and living their lives, right? And the proof is what happened with us, right? Initially, most of our tenants went home last March because there was no reason for them to be on or near campus. But slowly but surely, they all started coming back. And, we would ask them, why are you here? There are no classes. You're just going to learn on Zoom anyways. And they said, look, I'd rather be near my friends. I don't want to be stuck at home with mom and dad. I want to make my own decisions. And so, I think what we've learned is that online learning is a nice complement, but it's not going to replace or be disruptive. And the Zoom experience as a whole, I don't know for yourself, but I despise it, right? I would much rather do a face-to-face meeting or even an old-fashioned telephone call.
I agree. I mean, I'm enjoying this conversation with you right now, but I can't stand Zoom meetings in general. I just don't tolerate them all. And I get it. Everybody at some point needs to get away from mom and dad, something that I have to look forward to in the near future. So that's interesting. Now, just as we wrap up last few minutes, I just want to try and kind of challenge REITs a little bit. And I only do this, Sanjil, just to have a balanced conversation. So a lot of us do follow Ben Felix. We listen to his videos. And 2 years ago, he was talking about REITs and kind of diving into the evidence. First thing he said was from 1989 to 2019, that if you look at the kind of S&P Global REIT kind of index, it outperformed the MSCI World Index 9.24% to 7.77%. So that's good evidence to support REITs. But then he also found that if you kind of just went with stocks and bonds, you could make a portfolio. We go back to that 60-40. If you had a 60% allocation to small cap stocks and a 40% allocation to high yield bonds, then you could reproduce that return while not engaging in or not exposing yourself to risks that come with the real estate market. So his conclusion was, well, you could reproduce the return of REITs, but not expose yourself to the risk that comes in the real estate sector. What do you think about that? What's your take on it? As somebody who's there living and breathing this every day.
So there's a lot to unpack there, right? So I think I mentioned it earlier. First of all, you have to look at the point in time. 2019 was very different than where we are today, right? That was pre-pandemic. And the markets were very different, and real estate returns and expectations were very different. So I think that's the first point you have to look at, right? And we've already touched on this earlier in this call, where we look at how the markets are today. Are equities overvalued? Are the interest rates too low to generate returns from bonds? So I would say that's point one. Point two, to unpack what you just said, the 60-40 portfolio consisting of small cap bonds.
Small cap stocks, sorry, yeah, small cap
stocks and high yield bonds. There are a couple of things to unpack there. First of all, if you look at small cap stocks, you're looking at businesses that are not mature by definition, right? They're smaller cap. They're perhaps startup, newer businesses, have some differentiated risks, right? You could have technology businesses, perhaps natural resource or mining businesses in there, right? And so you've got sector-specific risks associated with that, and it's kind of the next step up from investing in venture capital, right? So is that where you want to be, where there's inherent volatility and risk associated with the underlying business, the industry, the stock market, and then you look at high yield bonds. High yield by definition implies higher risk, right? Who's issuing those high yield bonds? It's the organizations that need to be able to pay out higher interest rates. So, I think there are all sorts of opportunities where you can generate enhanced returns, but it's always commensurate with risk, right? So I think that's, when I look at real estate, the reason why I like real estate so much is I can understand the attributes of real estate. And for me as an investor, I think about I think about what Warren Buffett always says, right? Invest in what you know, right? And I don't know anything about mining. I know very little about technology. So for me to pick a basket of small cap stocks would be very difficult. Same thing, like how am I going to assess a high yield bond? I don't know the underlying risks of the company and why they are raising capital at the rates they're willing to pay. What I do know is that real estate, not only for myself who specializes in real estate, but for the average individual or investor out there, they can understand it. It's a very simple business model. You have a building, you rent it out, you collect rents, you pay it out. It's not rocket science, right? So, when I look at real estate, it's a simple to understand business model. There's no financial engineering involved. There's no unique specialty or attributes of the industry that makes it complicated, akin to rocket science. And so I like to invest in things that are easy to understand, that generate straightforward returns, and that I can explain to anybody. I don't want to have to convince somebody. I want to demonstrate what I do and say, this is a self-understood investment.
I think that's investing 101. Only invest in things that you understand. I think that will resonate with people. Sanjil, thanks again for taking the time to join me, and happy to see that the sector, student housing, has been so resilient. I think that's a great way to describe it. But pleasure to talk to you, and thank you for taking the time.
Likewise. Thanks, Yatin.
All right. Thank you once again to everyone who took the time to join me today. I am so grateful. And again, I have to emphasize this. Everything that is discussed on the podcast, it is for education and generating awareness only. There are no buy-sell recommendations. There is no advice here. I'm not a financial planner. But most importantly, before you make a decision, always do your own due diligence so that you can make the best decision for yourself. I cannot emphasize that enough. But if you're enjoying what you're hearing, please feel free to leave me a rating, leave me a review. It really helps to spread the podcast. I would be so grateful. And if you want to reach out to me, the best way to do so is either LinkedIn or beyondmdpodcast@gmail.com. I want to hear all the feedback, the positive, the negative. It's the only way that things are going to improve and the podcast is going to continue to grow. So hope to see you guys soon in 3 to 4 weeks. Until then, stay well, stay savvy.